like to grow it, because that starts fleshing out your capital strategy needs. And then you do the research and the networking and the hard work to get the answers to what the real world looks like and will think about your company. Now, that's sort of answers your question, Mark.
I'd just like to plus one what Tom mentioned there, that, you know, building out that capital or building out a financial forecast. I think a lot of startups look at it and say, well, I don't have enough information. I don't know what the market really is going to look like. I haven't reached product market fit. The financial forecast is an exercise for me as an investor that I look for a couple of things. One is I want to see how the founder thinks. Do they understand the flow of money? And so a financial forecast is more about competency than it is accuracy. What are their assumptions? Are those assumptions realistic? If the total addressable market is 100 million and they think they can get to 25 or 50 million of that, then that's probably not a realistic assumption based on what they're talking about. So really understanding how does the entrepreneur think? Does it make sense? Does the math work? Can we make everything? Can we make those assumptions work, and understanding the flow of money? And so it becomes more about an exercise in understanding the entrepreneur and what their capabilities as much as it is about the business. The other thing that financial forecast did, I think Tom Lopez mentioned it earlier, is you're not financing cash flow. You're not financing payroll or the purchasing of inventory or things like that. You're financing to get to that next milestone. And that forecast that you put together, that financial plan that you put together, helps you to define when that next milestone needs to occur, and what valuation do we need to get to? How do we justify that valuation in order to achieve that next round of financing? I see a lot of early stage companies that'll raise money, and they raise a lot of money early on, but then they struggle when they have to raise another round because they've either sold too much of the company off, or they don't understand how to achieve that next milestone with the cash that they have.
You guys are touching on so many great topics. I want to dive into each of them. First, I want to talk about these milestones and kind of a detailed operating plan. When we talk about those milestones and money it takes to get to each of them, how standard are those across industries, or how can you look at comparables and say, like, look, I'm in a SaaS business, and so the expectation is that this is the milestone, and at that point I will require X amount of dollars to achieve the next milestone. Is that something that people can kind of benchmark off of, or is that unique business to business?
I think that's unique. Each company and each marketplace and each customer set all have different objectives. The one thing I wanted to just throw in here was that a lot of times I really agree with what's been said by Tom and Tyler about building the plan and the pro forma. A lot of the things that I see, the plan is built top down rather than bottom up. In other words, a lot of people start with what they think the investor is going to want to see. And so they build a hockey stick on a spreadsheet, and they build their assumptions into the formulas. So if you really want to figure out what their assumptions are, you have to reverse engineer their pro forma spreadsheet. And a lot of times they really have not done the hard work to figure out what those assumptions are. So the thing that I look for right off the bat is, what are those assumptions? I want to know the assumptions more than I want to know the math that they use to get to their, the final pro forma.
And Tom, while you're speaking, can you kind of, from an investor perspective, what are the types of things that are either A, attractive, and this is what I'm looking for the type of investment dollars that I provide, and not just funding cash flow? And on the flip side of that, what are some yellow or red flags that says this is not a venture backable company, or this is not the type of investment that would suit this company, because it's not the end goal of where it's headed is not the end goal of where my dollars want to be?
The first thing is the CEO. I always look at the CEO as the bellwether for the investment. And if the CEO's skill set, their vision, all of these things are in place, then it can be a very positive thing. A lot of people become entrepreneurs because they want control over their environment. And I hate to break it to them that they don't have that control, and they work for the board of directors, and they work for their investors, and they work for their employees, and they work for all their stakeholders. So that control is illusory. And another thing is, I think a lot of CEOs are not as honest with themselves about what they really want. And in addition to the control, a lot of them want a good lifestyle. And so the alignment of motivation between the entrepreneur CEO and the investors is very, very important. And investors must have return on investment. That's what they're in it for. Whereas if the entrepreneur is looking for a nice lifestyle, you will have conflicts, and it can get ugly down the pike.
Hey, Mark.
Yes.
I want to give a couple of examples that help flesh out and also help make the CEO founder, as Tom's alluding to, demonstrate how thoughtful they are about the things that matter to the investor. And it goes back to the operating plan and the milestone thought process. I want to give two examples. One is I was helping an entrepreneur with their capital strategy, and they were at a point, they're still in the needing product market fit stage, and they decided they needed $2 million. And I was looking at their pro formas and whatnot. I said, well, why did you pick $2 million? And the answer was basically, it just seemed right. And then I pointed out to them that if they were gonna fall just short of profitability on their own pro forma numbers when they were gonna run out of money. And raised the question of, wouldn't it be more persuasive if they funded all the way to cash flow break even, if that were the milestone, right? So they needed to raise 2.5 total to get there, and then to consider, rather than falling off a cliff, right? Go ahead and achieve that desirable milestone that the investors are going to say, yeah, I like that. And then think about, okay, does 2.5 sound like a lot when we're still don't have product market fit? Maybe what we need is to turn this into two pieces. The first piece is we need to get evidence of product market fit that is appropriate to that product. And on the basis of that, you raise the second bite that gets you to the profitability. That's the kind of thought process that if you're the founder and you're talking to the investor, it presents a rational strategy that you can then debate, and then they'll quiz you about your assumptions and kind of all that stuff. So that's an example of where the capital strategy helps you as the founder have your shit together in terms of what you're doing, why, and how much, and so forth. A variation on the theme is for marketplace companies. If you have a marketplace idea, the capital strategy might well be, I'm going to prove my marketplace in Phoenix, Arizona. I'm then going to take, and if I get it where I'm starting to get traction, I'm going to go to 2 other cities that have characteristics I want to explore. And then if I get those, I will have the ingredients, I think, that I can then scale, right? I can then blow this thing out big and be a big company. Well, the capital strategy can follow that then. I need the money to prove out Phoenix, then I'm going to need money to prove out the next 2 cities. And if I get those 3 proved out and I'm getting traction, maybe I can then raise a mountain of money to build a really big company, or all kinds of variations of that. Does that make sense? That's the kind of what we all are talking about, of having an operating plan, milestones, and goals that fit who you want to be, and then being the kind of founder CEO that's appropriate for that game plan, or have a game plan that's appropriate to you and your DNA if you're not that kind of founder. It's a self-awareness and then digging in and doing the work. that I think we're talking about, rather than starting top down and just doing something because that's what they do in Silicon Valley.
Totally. And I think on some of those points, I want to go back to Annette for a moment, because she's got two unique experiences. One is being in a hardware space, the capital strategy is inherently different. And then also the fact that Annette has been brought in as CEO a few times. And so that idea of where do you want to be, what are the right people to get there, what does that say about your strategy, or how did you recognize that? And that, if you could talk about either of those items.
Yeah, so I mean, I'll be the contrarian here, right? I've raised money many times without solid financials. And the reason is because when I join a company, generally there's a big idea, but there's a lot of work to be done, a lot of IP to be filed. You know, you wouldn't talk to customers, potential customers, about your product market fit until you've actually developed a technology, right? And a lot of the funding goes to developing the technology, not selling a product. So it's really, you know, again, as we said at the very beginning of this call, determining what your company is, right? And what its capital requirements are. My company, this company is currently taking in $6 million and hasn't, well, I mean, they've sold a little bit this year, but it's very rare that a battery company would be less than $20 million of paid in capital before they make the first sale. So again, you know, you're funding different things. So you have to really figure out who you are and what it's going to take. A lot of non-dilutive capital is available for some of this and so forth. Having been brought in, I'm a turnaround manager in most cases, right? I am often brought in as the coach to the CEO. In this case, and in a couple of others, I was brought in as the executive chairman, operating chairman, and we see if we can work through the business. But often when there's a really big pivot, you know, investors will go to the founder CEO and say, you know, do you want to be king or do you want to be rich? And if you want to be king, this is not your country. So your objectives, I think one of the things we've been saying is that your objectives as a founder have to align with the objectives of the investors. And the investors have no interest in being in this company 50 years from now, you know, when your grandchildren are taking it over. The reality is they want to get in and get their return on investment. And, you know, you have to be aligned with that. So I think oftentimes I find myself trying to coach young CEOs, because everybody always says, you know, I know my limitations. But if your investors are questioning your limitations, or if those people who you are going out to pitch to, if you have a gargantuous market and you have a deck that's there and you have some solution for that market, which looks unique and defensible, then, you know, a no makes you go back and say, what do they see that I don't see? Instead of just saying, oh, you know, these guys don't get it, or trying to sell them harder on the big market, you have to sort of take a step back and say, okay, what did they see that I don't see? And the answer is not to say in an email, so I really appreciate your answer, I want some feedback, because guess what? You'll get, oh, well, you know, we're just not investing at this time, or there'll be some reason, but it's really upon a founder to sort of go out and seek counsel from folks who will give them the reality check, right? If it's not working, why is it not working?
And we see no's sometimes, and Tom Lopez, I'd love for you to talk about this, or start off the conversation, between a mismatch in the type of company and the type of investment. And so this goes back into the venture backable piece, but as someone on the venture side, Tom, I'd love for you to talk about what some of those no's can mean or look like, or why some of those no's happen that have nothing to do with the quality of the company, but maybe isn't a match for your type of dollars.
Well, one thing for sure, I have to understand the potential. And so, when I say material sciences is one of our areas, that's a very broad area. So within material sciences, it's got to be something that I can really relate to. One of the things that I wanted to point out, and Annette kind of underscored this in her discussion, we invest in CEOs. We invest in great ideas, great potential, but the CEO is the critical part of the whole thing. Many times, particularly in the science-based companies, we have an inventor as the CEO. And I'm not saying it never happens, but it's rare that an inventor will have the skill set and the knowledge base and the aptitude and frankly, the psychology to operate a business. They're just very different things. So it's important to me in first discussions with an inventor to make sure that not only is he open to, but he plans to bring in somebody to run the business. And so I don't want to be in a fight with this guy or gal a couple of years down the road over bringing in somebody who really understands how to run the business. One other point that I think we should underscore here for everybody is the difference between dilutive and non-dilutive capital. And for early stage companies, there are a host of non-dilutive capital sources. And people who don't explore them really do it at their own peril, because once you start taking in investment capital, you start giving up control of your company and control of your destiny. So make sure that the people that you invite in as investors, you're inviting them in really as partners in the venture.
Thank you, Tom. And you had mentioned earlier on our conversation this idea around delegation and how that was an important factor in kind of what to look for in something that maybe is scalable versus a quality business, but not venture backable, maybe angel investment, all around delegation. Can you talk about that?
Yeah, that goes back to the whole idea of founder versus CEO or inventor versus CEO. And as I mentioned, motivation for a lot of entrepreneurs is to get into something where they can have control. Well, companies cannot grow without real organization and without delegation of responsibility and the authority to pursue that responsibility. What I've seen many times is founders with a small group of people around them who are delegating tasks to those people. And so they're never building a team that can operate independently. They need to be in, some people call it micromanaging, they need to be in control of everything. Companies that do not have a CEO that delegates cannot grow. Span of control and span of communications limits that growth. So I look for that. Not only are they willing to do it, but are they planning to do it? It's kind of like planning to bring in a business manager. It's critical because you can fill out a large organization chart, but unless you're delegating responsibility and the authority to pursue that responsibility and the budget to pursue that responsibility and everything that goes with it, your company cannot grow.
So I want to turn now to kind of the other side of this conversation. And I think we've all been in situations or met with people that maybe didn't have a great capital strategy plan from the start. And so I'd love to hear, we can start with Tyler and then kind of go around the horn of some of the situations that you've seen or founders that you've met with that, what are the consequences of not having a capital strategy plan? What happens? What does that look like? And how do you bounce back from that? Tyler?
Sure, and I think a little bit goes back to a conversation or question you asked earlier is by industry or by business type, are there standards and almost a pro forma approach to raising capital and developing a capital strategy? And while every company is different, I think that there are some benchmarks and milestones that every company has to evolve through in order to get there. And there are certain standards that you should look at. For me, in the software side of things, I always, I call it the doubling methodology. So every capital raise, I should be at minimum, I have to double the amount that I'm raising and double the valuation of the previous round in order to continue to meet my thresholds. And I know that my early stage seed investment, or in current nomenclature, pre-seed investment, I want to sell off, 20 to 25% of the company. And then each successive round, there's a benchmark and target. So, this goes back to an early stage company of my own where I didn't fully understand what this having a capital strategy really meant. I went into it with what I thought was a good idea, and had some exuberant investors who were willing to put some money behind it. And they were willing to put more money in than I really thought was necessary in the onset. And I took more money than we needed as a result. And we burned through that capital before we got to product market fit, developing the technology. And as I went back, it was a very hard conversation to have with existing investors, and then raising more capital became much more difficult as a result, because we had raised so much and didn't achieve that milestone. While our next round wasn't a down round, it certainly wasn't at that threshold where people got excited about it. I also think that, as Tom Lopez mentioned, or as Tom Curzon mentioned earlier, breaking capital raises up is really important. I think scarcity forces companies to make better decisions around finances. And when you get too much money early on, it becomes difficult. So in my case, we had sold probably close to 40 or 45% of the company in that initial capital raise. And it was $2.5 million at a $5 or $6 million valuation, somewhere in that neighborhood. And we didn't make it to product market fit. So not only did we not get to a break-even point, cash flow break-even, to get to a revenue point where we could significantly demonstrate that we had product market fit, we now had to go back and raise more money in order just to continue developing and find product market fit. And it became much more difficult. So subsequently, as I've gone through this, I go into it with a real clear strategy of, this is how much I want to raise for the seed round. And I base it based on what I'm willing to sell. So whatever valuation I can justify will mandate what I'm going to raise. So if I can justify and substantiate through analogs or what's going on in the marketplace, or the long-term potential of the opportunity, a $5 million pre-money valuation, and I want to sell 20%, then I know how much money I'm going to raise in that first round, or each successive round, how much I'm going to raise. But it gives me some targets and thresholds to build around as I approach it, so that I'm not into a position where I don't have enough money, or I don't have enough capital left in the company, enough equity left in the company to future finance growth, to future finance bringing in investors, to achieve those milestones and break those milestones down a little bit.
Anyone else kind of open floor for our panelists that want to comment on either Tyler's words or some of the consequences of not having a strong plan?
I would, excuse me, I would like to. I think that a lot of entrepreneurs feel like they need to get the highest valuation that they can. And I think that's a big mistake. What they really want is the right valuation, so that the portion of the company that they're giving up gets them to the next milestone. And just in my mind, some of the milestones that people may be thinking about are a prototype, a working prototype of what the technology can deliver, or the software can deliver. A next stage is commercial launch. Another stage of break even, we've heard about that, and then a fourth stage of growth. So funding those particular milestones, you need to have the right valuation to do that. And we just heard of a situation where perhaps the valuation was not at the right point, but they gave up too much of the company. They didn't achieve the milestone. And in many cases, when you do that, when you don't achieve the milestone, because you've made your business plan so aggressive in order to support a high valuation, you didn't make the milestone. Well, the next time that you go out to raise capital, you're going to have a down round. And a down round can be a disaster there's a down round and there's something called a cram down. And that can be a disaster, not only for your shareholders and for your employees. Many of your employees may start thinking maybe this isn't the right place they want to work. It'll get back to your customers. It's just not worth it to go out for an inflated valuation because you'll pay for it in a down round or in other factors that'll happen in the future.
I think that's a really good point. And as you look at valuation, it can't just be about the valuation and how much it's costing you to raise that capital. When I raise capital, I always look at and try to evaluate investors on 3 criteria. What's the cost of capital? What's the value of that capital? So do they bring domain experience, or do they bring additional investors or potential customers? So what's the value of that? And then what's the cultural alignment? Are we aligned from a mission perspective? Are we going to be fighting each other? As you know, for me, my primary focus is on social impact and building companies that solve that double bottom line. And so having aligned investors who see the vision of making a capital return and a return on investment commensurate with the rest of the marketplace, but also solving a social issue and trying to do well by doing good is an important part of it. So I look at capital not only from the cost of capital, but what's the value of that capital, and are we aligned in our mission so that we're going to pull together as opposed to constantly moving apart. And that may mean sometimes that I've got to take a little bit higher valuation or a little bit lower valuation, and the cost of capital is a little bit higher for me because I get those other things that come in as part of it. So choosing investors is a really important part, not only from the standpoint of the cost of capital and alignment and understanding and having a similar exit objective as you move forward.
Thanks, Tyler. And with 10 minutes left, I just want to kind of call out 2 quick points. One is that this conversation has been really rich. I see a lot of positive comments about the topic. Is really focused on the strategic piece and the plan, the milestones, the comparables, the where you want to be. And as we start to get into conversations around kind of rounds and valuation, and I see some questions around initial capital or stock sales and things like that, we're going to continue to have panels that dive deeper into these topics around how do I set a valuation? How do I run a process? How do I think about different types of investment vehicles? And so with those types of questions, and as we get closer to those topics, just hold on to those and come back for the next future. This is a series on entrepreneurial finance. And so if you do have questions on kind of how to think about those milestones or that plan or things like that, feel free to shoot those over now. We've got a few minutes left, but I want to throw it back to Tom Curzon to kind of talk about how to put all of these pieces together. I know that you're coaching a lot of founders on this topic, and we've talked a lot about great things. So if you could help us sort of start to synthesize this information.
Oh, wow, that's a big one. It's storytelling, right? Storytelling is what the pitch is all about in order to get to that next meeting, right? For me, the capital strategy is the underlying bones of that storytelling and kind of helps inform that. And so the pulling it together, if you think about it in the context of a pitch, the pitch is going to be, there's a hook, why is this an exciting place? And then there's the story around, here is what our goal is, here's where we are in the process. And that all fleshes out in a way that needs to be appealing. But then it also needs to say, where are we in this journey? And I want you to join me in this. And then here is kind of where we are and where we're going. And for me, the pitches that are the most persuasive pull in a variety of elements, but one of them is I have a sense that the founder has a good idea of their game plan and that the game plan makes sense, right? And I measure it in part against capital strategy. When they don't have that, the storytelling doesn't work, right? It just doesn't. There's something about it that just is off in some way. They may raise money because there may be other elements that counter it. But I think for me, the pulling it together is in the context of of the storytelling of the pitch.
And Tom, there's a question, and I want to give our panelists an opportunity to answer this too, is what are the key factors you initially evaluate to determine if the company is worth to invest in? And we can answer that in a second, but what I'm hearing from you and from this conversation is kind of turning that question upside down and saying, as a founder, what is your need for investment? What is your motivation for that? Where are you going with those investment dollars? And then finding the investor that is already playing in that space and saying, as a founder, here's my story of where I'm going. Here's why I need that money. And here's the pool of investors that match that plan, that process. Is that fair?
Yeah, it's totally. And part of the art of the raise, I think Tom Lopez actually provided a really strong clue of, is fish in the right pond, right? Go after people who have an intuitive interest in what it is you're doing, whether it's material science or software or markets or batteries or whatever. Find people who've invested in the space before, who have a background, look for clues, right? And to me, and so fish in the right pond is a part of that. And then knowing why you're excited and where you are in your story. But and I will say, one of the things that I think looms the largest is, where are you in product market fit today? I think that is kind of the number one thing in terms of being very clear in your storytelling where you are on that, because increasingly investors want to either see that you've achieved it or that there is strong evidence you'll achieve it, and so you need to be able to talk about that. And if you haven't, you need to be mindful of which pond you're fishing in again.
And something that I think I want to underscore and make sure that is clear is that fishing in the right pond might not necessarily mean VC. Fishing in the right pond could mean angel investors. It could mean bank debt. It could be kind of friends and family and bootstrapping. Is that fair, that the pond is bigger than just finding the right VC with the right investment thesis? Annette, I see you nodding.
Yes, I think that's backing up to the beginning of this call, making sure that the folks that you bring in as investors, whatever type of investors that they are, they have the same alignment on what the outcomes are going to be or what their expectations are. Most of investing is about expectation management. If it is that you're looking for the right investor in the venture world, for example, I would say, we're talking at a very broad level, but I'd say get down to the nitty gritty. It's not just which fund to go to, it's which partner at which fund, right? Every partner has a different focus and a different area of interest and expertise. If you're talking to somebody who doesn't understand the technology and then they've got to go in their partner meeting and make a pitch for you, it's kind of crash and burn. And then non-dilutive funding, how far can you take that before you have to take you get a product market fit? Because most of the non-dilutive capital requires, they'll set aside a certain amount for you to do that market research. So there's good opportunities there.
That's great. And so as we think about, go ahead. I heard, is that Tyler?
Yeah, I was just going to say that fishing in the right pond not only is finding investors who are interested in the space that you're working in, but really understanding from the investor's perspective, what type of return they're looking at. Angel investors and early stage investors are, they're looking for a bigger return because they're taking more risk. And so understanding that from the investor's perspective, what they're looking for and what they require really makes a difference as you're telling that story. Because you can pitch to what it is that they're looking for and what's going to satisfy their needs. So understanding the pond isn't just about finding the right VC firm or finding the right type of investor, but what is it, where you're at in the process of raising money, at which stage you're at, who the right investor potentially is.
So last question, and then we can kind of go into final comments, is with this planning phase, I know founders are spending time trying to build a product, get customers, create their pitch deck, do all of these different things. Where does this process fall into everything else that's on a founder's plate?
For me, I think it's the foundation that you build from. I think you have deliver that? What is it going to take in order for me to deliver that that future? And so that financial foundation is an important part. And whether you are really good at predicting the financials and you have a finance background or not, I think it's really important for you to spend time understanding the financials of your business, understanding what is it realistically going to take in order for me to achieve these milestones, and what are the milestones that I'm trying to achieve in order to get there from a finance perspective. And so it becomes the foundation. You can build something that's a truly amazing product, but if you can't make it work financially, it'll never get to market. And so that becomes the foundation that you build from to understand your constraints, limitations, market, and everything else.
And I would say before you start the plan even, you need to do the research. And you need to get out and go to the shows and find out where the science resides, read university science papers. You have to understand the context in which you're going to operate. I really put a lot of emphasis on founders and CEOs who really understand their customer just in their heart. They don't have to, it's not an intellectual exercise. They really can identify with their customer and understand what makes them tick. They also understand where they fit in the food chain. Do they need to go through distribution? Is this a licensing business? And all of this is a huge amount of research that needs to be done, because that's the research that drives the assumptions. The assumptions drive the plan.
Awesome. Well, it's noon now. I want to take one last opportunity to thank everyone for attending. A special thank you to our panelists for just really incredible comment. I'm already starting to get feedback about how valuable this topic is. I want to reiterate one more time, this is the first in a series of panels on entrepreneurial finance. We will be back with more topics that get even deeper into topics like cap table structure, fundraising process, working with VCs. So I encourage you to come back for those. If you have feedback for me on the format or the types of topics you'd like to see in the future, feel free to send my way. But otherwise, I'll kind of say thank you one more time. If any of our panelists have any final thoughts or last comments, feel free to share them. Otherwise, I will see you all on the next one.
Thanks, Mark. Thanks, everybody.
Thank you.